Hello everyone, Yana is here. Welcome to Financial Accounting. In this video, we're going to look at the year-end cutoff of transactions, look at the goods in transit, discuss the difference between F.O.B shipping point and destination, and look at a couple of examples. If you are interested in learning more about inventory, cost of goods sold, and inventory valuation methods, I posted the links in the description box. Now, let's look at the year-end cutoff of transactions. It is essential to make a proper cutoff of transactions while preparing reliable financial statements. Companies should ensure that the purchases and sales of inventory occurring near year-end are recorded in the correct accounting period. One aspect of a proper cutoff is deciding that all purchases of goods through the end of the period are recorded in the inventory records and included in the physical count of goods on hand at year-end. Likewise, it is essential to ensure that the cost of all goods sold through the end of the period has been removed from the inventory accounts and included in the cost of goods sold. These inventory items should not be counted during the year-end physical count. If sold goods are not shipped and invoiced in the accounting system as of year-end, the quantities shown in the inventory records will exceed the quantities on hand. These unrecorded sales could be mistaken for inventory shortages when the physical count results are compared with the inventory records. Making a proper cutoff will most likely be impossible if sales transactions happen while inventory is being counted. Therefore, many businesses count their physical inventory during non-business hours, even if they must shut down their sales operations for a day or so. Remember, we studied the matching principle? It is one of the basic underlying guidelines in accounting. The matching principle directs a company to report an expense on its income statement in the period that related revenues were earned. We must determine that the sales revenue and the cost of goods sold relating to sales transactions that occurred near year-end are recorded in the same accounting period. If not, the revenues and expenses from these transactions will not be matched correctly in the company's income statement. A sale should be recorded when the title to the merchandise passes to the buyer, regardless of whether the buyer received the goods or not. In making a year-end cutoff of transactions, when goods are still in transit between the seller and the buyer, it is essential to determine which company owns the merchandise. The answer is determined by looking at the terms of shipment. If these terms are F.O.B shipping point, title passes at the point of shipment and the goods are the buyer's property while in transit. F.O.B stands for free on board. If the terms of the shipment are F.O.B destination, the title doesn't pass to the buyer until the shipment reaches its destination. In this case, the seller owns the goods while they are in transit. The type of F.O.B to be used is typically designated in a buyer's purchase order and is also stated on the seller's invoice to the buyer. If terms are F.O.B destination and the goods are damaged in transit, the seller should file a claim with the insurance carrier since the seller had title to the goods when the goods were damaged. If terms are F.O.B shipping point and the goods are damaged in transit, the buyer is responsible for the goods. Further, if F.O.B shipping point is used, sellers can recognize revenue when goods are delivered to the common carrier. Therefore, sellers prefer F.O.B. shipping point and buyers prefer F.O.B. destination. Before we move on, let's take a closer look at common carriers and why they are important in our discussion about shipping terms. If the shipment is an F.O.B. shipping point, the title transfer occurs at the time and place of shipment, which is generally by a common carrier. A common carrier is a person or a commercial enterprise that provides their service to the general public. It transports passengers or goods for a fee. Examples of common carriers include a ship owner, railroad, airline, taxi service, etc. On the other hand, a private carrier only agrees in particular circumstances to transport passengers or goods. Private carriers don't offer their services to the general public. They enter into a contract with each customer without the assumption that a similar contract will be available to the next customer. To make sure all sales are recorded in the appropriate period, it is recommended to review all invoices generated in the last months of the calendar or fiscal year, trace tracking numbers to the shipping documents to determine when the goods are shipped, and review buyers' purchase orders to see whether the terms are F.O.B. shipping point or destination. If goods are shipped in the last months of the year, but delivered in the following year, sales should be recorded in the current year. If the terms are F.O.B. shipping point, and in the following year, if the terms are F.O.B. destination. To make sure all inventory is recorded in the right period, it is a good practice to review the receiving log for the first month of the following year and corresponding invoices to determine the terms of shipments. If terms are F.O.B. shipping point and goods were shipped in the prior year, inventory should be recorded in the same year. The journal entry will be a debit to inventory and a credit to accounts payable or other payable. Let's look at an example. Software City had 2 large shipments in transit at December 31st. One was a 230,000 inbound shipment of merchandise shipped December 28, F.O.B. shipping point, which arrived at the company's receiving dock on January 2nd. The other shipment was an 85,000 outbound shipment of merchandise to a customer, which was shipped and billed by Software City on December 30, terms F.O.B. shipping point, and reached the customer on January 3rd. In taking a physical inventory on December 31st, Software City counted all goods on hand and priced the inventory on the basis of average cost. The total inventory amount was $700,000. No goods in transit were included in this amount. What amount should appear as inventory on the company's balance sheet at December 31st? The inventory at December 31st amounts to $930,000, computed by adding the $230,000 inbound shipment of merchandise to $700,000 of merchandise on hand. Terms of the $230,000 shipment were F.O.B. shipping point. Therefore, the title passed at the point of shipment on December 28th, and the goods were the property of the buyer, Software City, while in transit. In addition to the $230,000 increase in inventory, accounts payable would be increased by $230,000 to reflect Software City's liability for the goods in transit at the end of the year. The $85,000 outbound shipment was recorded correctly. Because goods were shipped F.O.B. shipping point, title to these goods passed to the Software City's customer on December 30th, so they are not part of the Software City inventory at December 31st. This shipment was billed on December 30th, so the accounts receivable is properly included in the balance sheet. Let's review what materiality is. In accounting, materiality refers to the impact of an omission or misstatement of information in an organization's financial statements on the users of those financial statements. If it is possible that users would have changed their decisions if the information hadn't been omitted or misstated, then the item is believed to be material. If users wouldn't have changed their decisions, then the omission or misstatement is considered to be immaterial. Sometimes companies ignore the distinction between F.O.B shipping point and F.O.B destination because inventory in transit usually arrives within a day or two. In such cases, the amount of inventory in transit is usually not material in dollar amount. The company may decide to follow the most convenient and less time-consuming accounting procedures. Usually, the easiest way is to record all purchases when the inbound shipment arrives at the warehouse. Likewise, the easiest way to record all sales is when inventory is shipped to the customer. This simplification only works where inventory in transit is relatively small or immaterial. In some industries, inventory in transit at the end of the accounting period may be very material. For example, oil companies at any point in time may have millions of dollars of inventory in transit in pipelines and supertankers. In these situations, the company must consider the terms of each shipment in recording its purchases and sales. This is one of the areas that is heavily tested by internal and external auditors, as the improper recording of sales and purchases may have a material effect on financial statements. Thank you for watching this video. I hope you found it helpful. Please like and subscribe so you don't miss future videos. I will see you soon.